We are going to explore how you can purchase a home with minimal upfront costs and credit scores as low as 500 thanks to FHA loans. We'll discuss the 2024 requirements for FHA loans, answer common questions surrounding them, and run through some essential calculations regarding mortgage insurance. Perception that many people have that FHA loans are exclusively for first-time homebuyers is simply not the case. Anyone can take advantage of an FHA loan, whether you're buying your first home or whether you own several properties. It is not limited to individuals with low credit scores or low down payments. The reason we are focusing on FHA over conventional VA or USDA loans is that FHA loans offers the most accommodating qualifying criteria for homebuyers. They accept lower credit scores, allow for smaller down payments, and permit a higher debt-to-income ratio, meaning you can manage more debt and typically qualify for a larger home with an FHA loan. Let's start with credit scores, as they are crucial to when it comes to FHA loans. Many individuals hear that you can qualify with a score as low as 500 and immediately assume that if their score is 500 or even 550, that they will qualify for an FHA loan. Yes, they do allow credit scores as low as 500, but there's a catch. If your score is below 580, you will need a larger down payment of 10%. To qualify for the minimum down payment of 3.5%, you need a credit score of 580 or higher. If your credit score falls between 500 and 579, you'll be required to make a down payment of at least 10%. Even if you have a score of 500 to 579 and can put down 10%, this still does not guarantee FHA approval. It's crucial to understand that the chances of obtaining an FHA loan decrease with lower credit scores, as lenders will consider various other factors before granting approval. Typically, loans with lower scores will undergo manual underwriting, meaning the lender will scrutinize your financial profile more closely. In contrast, loans with those with higher credit scores may still be reviewed thoroughly, but may not be nitpicked to the same extent. Earlier, we discussed the down payment requirements linked to credit scores. Usually, those seeking FHA loans plan to make the 3.5% down payment if they meet the criteria. Let's break that down. If you're purchasing a home at $100,000, your down payment would only be $3,500. For a $200,000 home, it would be $7,000. For a $300,000 home, it's $10,500, and for a $400,000 home would require $14,000. $500,000 home would need $17,500, with prices continuing to rise from there. However, it's worth noting that FHA loans are subject to loan limits, which vary depending on your location in the United States. In lower cost areas, the loan limits are less than loan limits found in higher cost areas. FHA loan limits are usually updated annually, and you can find the latest limits in the comments section below to stay informed. It's important to understand if you're looking to buy a home above the FHA limits, you can still use an FHA loan, but you will need to make a larger down payment to cover the difference. Another crucial aspect to consider is mortgage insurance. FHA often gets scrutinized for its mortgage insurance requirements, with some advising never to buy a home without a 20% down payment to avoid it. However, the reality is that mortgage insurance is not as bad as it's made out to be. It is simply the cost of doing business. Unless you can afford a 20% down payment, you will have to pay mortgage insurance, regardless of the loan type, via FHA or conventional. So unless you have a substantial savings or a larger down payment, or have family or friends that can help with that down payment, mortgage insurance is unfortunately unavoidable. The first 3 properties that I bought, I had mortgage insurance. For me personally, looking back at the money I made from the homes appreciating and the savings I had from not paying rent, even though I was not paying mortgage insurance, it made sense for me. And I am glad I started investing in real estate instead of waiting until I saved the 20%. Talk to a mortgage professional to see what is best for you. A few years ago, FHA implemented a change where mortgage insurance on an FHA loan is required for the entire life of the loan. This means that even if you build equity in your home, if you opted for the 3.5% down payment, you still have to pay mortgage insurance. However, if you decide to put down 10% when purchasing your home, the mortgage insurance on an FHA loan will be removed after 11 years. For most individuals taking out an FHA loan typically go with a 3.5% down payment. It is one of the key advantages of this loan type. Consequently, if you choose this option, the mortgage insurance will remain until you fully repay the loan or refinance to another loan type. A common question about FHA loans is whether you can refinance or not into a conventional loan into the future. Yes, you can, as long as you qualify for the new loan. Starting with an FHA loan allows you to build equity and pay down your principal balance. Eventually, you can refinance into a conventional loan that does not require mortgage insurance. If you find value in this video, please give me a thumbs up. This will help the algorithm share it with more people like you. Also, consider subscribing to the channel to stay informed about FHA, mortgages, and real estate topics. I discussed why FHA loans are considered the most accommodating and versatile among loan programs. One reason is that they permit a higher debt-to-income ratio. This is also known as DTI. Let's break this down for you. Simply put, it is your monthly debt reported on your credit report compared to your monthly income. This does not account for expenses like your cell phone bill, groceries, or childcare. While these should be considered in your personal budget, this is not included when a lender calculates your DTI qualifications. The debts that count are those that show on your credit report, such as installment loans, car payments, credit card balances, and student loans. To find your debt-to-income ratio, you add up all of your minimum monthly payments for these debts and divide that total by your gross monthly income. This gives you your back-end ratio, which is used when qualifying for a home loan. FHA loans are lenient because they allow for front-end ratios of 47% and a back-end ratio of 57%. The front-end ratio is talking solely about your housing costs, your mortgage payment, property taxes, homeowners insurance, and any HOA fees. The back-end ratio includes these housing expenses plus your other monthly expenses like we just discussed. If you have no other debts, your front-end and back-end ratios will be the same. Let's go through a quick example to illustrate this. Suppose you earn $60,000 a year, which equates to gross monthly income of $5,000 a month. Now let's say you have a $250 car payment, $250 credit card payment each month, which adds up to $500 of monthly debt. Let's assume now your housing expenses of principal, interest, taxes, HOA fees, these total $2,000 a month. To find your front-end ratio, you divide $2,000 by $5,000, which gives you 0.4 or 40%. This meets the FHA requirements for the front-end ratio. For the back-end ratio, add your housing expenses of $2,000 to your other monthly debts of $500, which totals $2,500. Divide that by $5,000 income to get 0.5 or 50%. This also fits within the FHA backend ratio guidelines of 57%. Please note that this video is for informational purposes only. Always speak to a lender to get an accurate assessment of your eligibility. This video is to inform and help you understand the process. It is never too soon to talk to a mortgage professional or to discuss your situation. If you would like to talk to me or someone on my team, please click the link below to speak with us or to apply for loans. Always get multiple quotes to ensure you are getting the best deal. Just because one bank or lender turns you down, that does not mean you won't qualify for someone else. Banks have additional requirements or overlays, such as higher minimum credit scores. For the best outcome, work with a professional and rely on trusted referrals. Let's talk about some additional FHA requirements like property type, income, and employment guidelines. Before diving into that, a frequent question about FHA loans is, what are the interest rates? Generally, FHA loans interest rates are more favorable compared to conventional loans, particularly with buyers with lower credit scores or lower down payment. This is what makes FHA loans an attractive option, although you do need to factor in the cost of mortgage insurance alongside the interest rate. A major advantage of FHA loans is that the mortgage insurance rate is consistent with most borrowers, especially for those putting just 3.5% down. Regardless of your credit score, if you choose the 3.5% down payment option, your mortgage insurance rate will be 0.55%. You might wonder, what does that mean in practical terms? Let's walk through a quick calculation to clarify. For this example, we'll use a home purchase price of $400,000, assuming your credit score is above 580. You will need to put down 3.5%, which equates to $14,000. Subtracting that from the purchase price gives us a base loan amount of $386,000. You also need to know that FHA loans also require upfront mortgage insurance, which applies to every loan regardless of the down payment or credit score. This rate is fixed at 1.75. While you can pay this upfront, most people choose to finance it into their loan. This means that part of your down payment will essentially cover this upfront insurance cost. So we take the $386,000 loan amount and multiply it by the 1.7%, resulting in a new base loan of $392,007,055. To calculate the annual mortgage insurance cost, we multiply this new loan amount by 0.55%, which equates to $2,160. Dividing this annual amount by 12 gives us a monthly mortgage insurance payment of about $180. This method can be applied to any purchase price to estimate your monthly mortgage insurance cost. However, use these calculations as a general guide and always consult with a mortgage professional to get precise numbers. Now let's talk about the types of property eligible for FHA financing. FHA loans can only be used for primary residences, meaning the homes that you intend to live in. They do not support financing for investment properties that you do not intend to dwell in. A common question we get asked is, can you buy a primary residence with FHA and later convert it into an investment property? The answer is yes, although there is not a strict requirement from the FHA guidelines. It is generally recommended to live in the property for about a year before renting it out. Interestingly, if you are looking at multi-unit properties like duplexes, triplexes, fourplexes, you can live in one unit and rent out the others using an FHA loan. The great part is you can still qualify with a minimal down payment of 3.5% for up to 4 units. But note, in high-cost areas, it can be challenging to purchase multi-unit properties with just 3.5% down due to the FHA self-sufficiency test. This applies to 3 and 4 unit properties. For single-family homes or duplexes, the self-sufficiency test does not apply, making it easier to qualify with a smaller down payment. Loan limits increase with the number of units, which help you qualify for a higher price property with the same 3.5% down payment. If you're interested in strategies like house hacking or purchasing multiple unit properties, ensure that you discuss with your lender during the pre-approval process. When it comes to buying a primary home with an FHA loan, there are several things to keep in mind. FHA loans require the property to meet basic standards, and if you are purchasing a single-family home, you are usually in the clear. These properties do not have to be officially approved as FHA compliant since most single-family homes qualify. However, there are specific conditions. You cannot have peeling paint. You have to have a working heating system, installed appliances, and no safety hazards. Most properties will meet this criteria without issue. The situation is a bit more complex with condos. Condos must be listed on the FHA-approved condo list. While many are, not all complexes have undergone the FHA approval process. If the condo you are interested in is not on the list, you either have to go through a spot approval process, which can be tedious, or choose another property. For your convenience, I included a link in the video description to check if the condo you are looking at is FHA approved. Additionally, I suggest consulting a local realtor that can dig deeper into the approval status, and because finding this information can be a little tricky sometimes. Now let's talk about income and employment requirements, which often raise many questions. You generally need 2-year work history in the same field. Small gaps are acceptable, but long periods of unemployment can be problematic. Consistent employment with a steady income over the past 2 years is key. For example, if you started as a hostess and then became a server, you are still in the same line of work and likely to qualify. But if you switch from a W-2 job like hosting to a commission-based role like a loan officer without a history in that field, it could complicate your approval. Income consistency is equally important. If your income is stable or shows a steady increase over time, you are likely in good shape. Even if there is a slight drop followed by an increase, as long as the overall trend is followed by an increase, you will be fine. But don't try to figure this out on your own. Consult a professional to analyze your income and your financial situation before going and looking at homes. The mortgage process is just one part of the home buying journey. Like I said earlier, check out that first-time home buying course. It's completely free. There's a link if you want to get connected to a real estate agent in your area. And there's also a link if you'd like to talk to me or one of my team members about your loan options. And there's even a link to apply for a loan. So check out those links below, and I'm excited to see you in the next video.